Okay, this video covers finding the effective interest rate. The effective interest rate, and this relates to long-term debt and bonds specifically. The effective interest rate is what the required rate of return that investors are requiring to invest in our company's bonds. And so this is different from the coupon rate. The coupon rate is stated in the bond that the company issues, and it determines what the coupon payments that the investor will receive will be in terms of their amount. The effective interest rate, on the other hand, is the rate of return investors are requiring. So why would we want to find the effective interest rate of bonds that a company is issuing? Well, because it'll give us an idea of how risky is that company. A riskier company will have a higher effective interest rate. And so this tells you a little bit about how risky investors think a company is at the time that the bonds are issued. So let's just move on and talk specifically first about the accounting rules for bonds. And this is 3 steps. First, when a company issues a bond, they record an initial liability equal to the cash proceeds that they receive from the bond's issuance. Step 2 is the step that we're going to be using, which is an equation. It's a formula. Interest expense is equal to the effective interest rate times the beginning of period book value. So we can solve, and let me get my laser pointer. We can solve for effective interest rate by rearranging this equation. So if you divide each side by beginning of period book value, you get that the effective interest rate is equal to interest expense divided by the beginning of period book value. So we'll be using this formula. And finally, number 3, this kind of determines the journal entry that companies record each year when they make coupon payments. They'll credit cash for the coupon payment. They'll debit interest expense for the effective interest rate times the beginning of period book value. And then the plug in that journal entry, because those 2 amounts aren't going to be equal, is going to amortize the bond's book value to its face value. So let's just move on and look at the specific example of Bausch, don't know how to pronounce that, Health. And so this is a healthcare company. And here I've got an excerpt of their balance sheet, the liabilities section of their balance sheet. And they've got 2 relevant accounts here on the balance sheet. The current portion of long-term debt and others. So that's giving me a little heartburn that there's something else in this account. But let's just ignore that for the purposes of this video. Let's just pretend this is the current portion of long-term debt. And here's the non-current portion of long-term debt. So this is the present value here, 1, 2, 3, 4, as of 2019. That's the present value of debt that matures or becomes due within the next 12 months after December 31st, 2019. Okay, that's the 1, 2, 3, 4. The 24,661, that's the present value of debt that becomes due greater than 12 months from now. Okay, so when you add these 2 together, you get the total book value of long-term debt. And before we move to the next slide, let's put something into our memory, which is what is the beginning of year book value of total long-term debt? And ignoring this and other thing here, it's 228 plus 24,077, because that's the end of 2018. So that would be the beginning of year 2019. So the beginning of year book value of long-term debt for this company is 228 plus 24,077. So now we're going to the income statement. And this is kind of a long income statement, but let me just show you which line item we're interested in, which is interest expense down here. And the other thing that might give you a little bit of heartburn here is that interest expense doesn't necessarily always reflect total interest expense, believe it or not. And the reason for that is some companies actually capitalize interest. So when they've borrowed money and they're using that borrowed money to construct an asset, rather than charging the interest expense to the income statement, they're permitted to capitalize interest expense into an asset account, and then it would be depreciated when the asset is depreciated through its useful life, and that will show up in depreciation expense. So that's another thing that'll give you a little bit of heartburn with this firm-wide calculation that we're going to do at first. The first thing is that in the beginning book value of long-term debt, the current portion, there was some other stuff in there. And the second thing that gives us heartburn is that interest expense might not fully represent all of the interest expense of a company. So if we calculate the effective interest rate on a firm-wide basis, we would just take interest expense over that beginning book value. So 1612 right here is what's presented as interest expense. And beginning book value is that 24077 plus the 228. So you can do this on a firm-wide basis. And you come up with 6.6%, which is an idea of how risky that company was when they originally issued their debt. So 6.6% is pretty risky. It's not a low risk company like, Apple, which sells iPhones. Apple probably has a lower interest rate than that. Who might have a higher interest rate than that? Bed Bath & Beyond. That's a pretty risky company. Sears, about a year ago, which was about a year before they went bankrupt, they were pretty risky. So this interest rate is pretty risky, but it's not as risky as it gets. And so as an investor, you could compare what you calculate here with Bausch. You could compare that number to another company and see how risky another company is. Okay, so that's the idea of calculating the effective interest rate on a firm-wide basis. So that's the firm-wide effective interest rate. Now I'm going to do a robust job. So I don't have any heartburn about this next calculation. This is a robust calculation of the effective interest rate of a specific bond issuance. So this table that you're seeing right now is from the long-term debt footnote that Bausch Pharmaceuticals presents below their financial statements. And this lists out all of their bond issuances one by one. And the one that we're going to focus on is a senior secured note, and it's 6.5% secured note. 6.5% refers to the coupon rate. That's typically companies will put the coupon rate in the title, in the label of the bond issuance. So it's a 6.5% secured notes. The maturity date is in March 2022. The principal amount is 1,250, and it was the same amount of principal outstanding at the end of the last year, which was 2018. So this year is 2019, last year is 2018. The principal amount has not changed. That's still the amount that if investors in the bond will receive the maturity date payoff of the total face value. So this is the face value here, 1,250. The book value of the bond in 2019, at the end of 2019, was 1,242. At the beginning of 2019, or the end of 2018, it was 1,239. And always make sure you can tie this table back to the balance sheet. So you see this table, here's the 24077 that you see in the long-term section of the balance sheet. And here's the 228 that you see in the short-term section of the balance sheet. And so here's the other. Here's what was giving us heartburn at the beginning. And now that I see it, I'm not actually that worried about it. Looks like it's probably is long-term debt of some sort because it's in the long-term debt table. Okay, so now what we're going to do is we're going to calculate the effective interest rate on this particular bond issuance. And so I'll blow it up a little bit. And first, what we need to do is figure out what was the 2019 journal entry for this bond. And step one in that process is to determine, well, what was the coupon payment? And you compute the coupon payment by taking the coupon rate, which is 6.5%, and multiplying by the principal or face value, which is 1,250. So when you take 6.5% times 1,250, you get the amount of the coupon payment, which is $81.25. And this is all in thousands or millions or something. But so I'm just going to pretend that we don't need to multiply by 1,000 or something like that. So 81.25 is the amount of the coupon payment. So let me start filling out this journal entry with a credit to cash of $81.25. Now, I don't know, it could be that they haven't paid it yet, and then in which case you would credit a interest payable account. Here, I'm just crediting a cash account to simplify. A cash account, that means it's a coupon payment to investors of $81.25. That is the coupon payment that the company owes investors in the bond. Okay, that's the first part of the journal entry. The next part of the journal entry would usually be calculating interest expense by taking the effective interest rate times the beginning of year book value. Well, here's the beginning of year book value, 1,239. This is the value net of premiums, discounts, and issuance costs. So by the way, this is a discount because 1,239 is lower than 1,250. And you can see that the book value is working its way up to 1239 up to 1242, it's working its way up to face value or the principal amount. So what we see normally what we would do as an accountant is we'd take the effective interest rate, multiply it by this beginning of year book value, and that would be interest expense. The problem is we're not given the effective interest rate anywhere as investors. We are typically not given that. Sometimes companies will give it to you. Bausch is not giving it to you. So, okay, we can't fill out the interest expense portion of this journal entry. What can we fill out in this journal entry? Well, we know how much the book value has been amortized during 2019. We see it. See this amortization? It's happening right in front of your eyes. It's going from 1239 up to 1242. So how do you make the book value of a liability go up by 3? You credit the account by 3. So we know that this debt balance was credited by 3 during 2019. That's how it went from 1239 to 1242. So we can fill in that part of the journal entry, a credit to the debt account of 3. Now we can just simply plug the journal entry for the amount of interest expense. So that becomes easy. 81.25 plus 3, that must be the amount of the debit to interest expense. So a debit to interest expense of $84.25. Again, this is probably in thousands. Might even be in millions. Okay, so this is the journal entry. And I'm 100% confident in this journal entry here. So the next thing we can do is now calculate the effective interest rate now that we know interest expense for this particular bond issuance. So again, the effective interest rate is interest expense divided by beginning book value. So interest expense is this 84.25. Beginning book value is 1239. It's right here. And when you do that math, you get 6.8% as the effective interest rate on this particular bond issuance. And so that's the answer. We have now found the effective interest rate on the issuance of this particular bond. And 6.8, this is a little higher than the 6.6 firm-wide amount. So either there was some measurement error in that firm-wide amount, or the firm was riskier when they issued this bond than when they issued all of their other bonds on average, because 6.8 is higher than the 6.6% firm-wide effective interest rate. A higher rate of return required by investors means a more risky company. Okay, enough of that. So the last thing I would do is just check your work. So this 6.8% effective rate is higher than this 6.5% coupon rate. And when you have a higher effective rate than a coupon rate, what are investors saying? Well, they're saying that coupon rate sucks compared to the effective rate that I am requiring. So I'm only going to pay you less than face value for this bond issuance. So in other words, when an investor pays less than face value, the investor is getting a discount from face value. And that's exactly what we see. Face value is 1250 and the book value is lower than face value. So this bond was sold at a discount when it was originally sold. And that makes sense based on the difference between the effective rate being higher than the coupon rate. Okay, so the end, that's it. That's what I wanted to go through is finding an effective interest rate using financial statements and footnotes. So I hope you had fun there. I know I did, and I'll talk to you on the next one. Bye-bye.